Hi everyone, in today's video I'm going to explain why the government keeps increasing interest rates. I'll teach you about monetary policy. I'll let you know why it costs more to buy a house today than it did a few years ago. And then if you stick around to the end of the video, I'll let you know how you can take advantage of the rising interest rate market. So first we need to answer the questions. What are interest rates? Who's controlling these rates? And why do they change? So interest rates are the price that you pay to borrow money. If interest rates are high, then you pay more. If interest rates are low, then you pay less. For example, if I loan you $100 at an annual interest rate of 2%, then at the end of the year, you'll pay me back $102. If the interest rate was 10%, then you would pay me back $110. Therefore, just because the interest rate was higher, you paid me 5 times more in interest. With these small numbers, it's not a huge deal, but once you get into mortgages and higher balance and longer term loans, it starts to add up. However, there is a side to interest rates that not a lot of people talk about. It's called the federal funds rate. This is the rate that the government sets and what interest rates from the banks are controlled by. The banks are actually borrowing money from the Federal Reserve at this interest rate, and the bank has to upcharge this rate to their customers so they can make money off the spread. The spread is the difference between what they charge you to borrow versus how much they are being charged to borrow from the government. For example, if the federal funds rate is 4%, then the banks will charge their customers 7%. So therefore, they make a spread of 3%. If each day the banks loan out $1 million in mortgages and loans, the customers, which are you guys, will be paying a total of $70,000 in interest. And the government gets paid $40,000 and the bank makes $30,000. So why do these rates change and why not keep them the same all the time? This may seem direct, but the government changes rates to control the economy. And this is where we get into monetary policy. Monetary policies are set by the government to control the overall money supply and also to fuel economic growth or decline. There are two main different types. It's called the contractionary policy and the expansionary policy. The easiest way to remember this is whenever you contract something, you bring it in or make it smaller. Whenever you expand something, it gets larger and grows. Therefore, expansionary policy is set into place whenever the government wants the economy to boom and expand, while contractionary policy is set into place whenever the government wants to reduce spending and slow down growth. When the government begins to issue or change these policies, it's mainly based off of inflation. Inflation is the overall increase of the cost to buy something, which is based off of supply and demand. For example, if today eggs cost $5, but last year they were $4, there's been an increase of 25% in inflation for those eggs. But how does this play into interest rates? When the government wants to control pricing, they'll start to control the price to borrow money, which is the interest rate. If the price to borrow money increases, then less people will borrow money because it's too expensive. If the price to borrow money decreases, then more people will borrow money because it's cheaper, which then affects supply and demand, which is the main factor that causes inflation. So think about it this way. If interest rates are low, then more people are borrowing money from the banks to buy houses and cars, eat out, and go shopping. Therefore, demand for those goods are higher, so prices increase because people can afford to pay more. If interest rates are higher, then less people are borrowing money from the banks, so less people have money to buy those things. So demand drops along with prices. Companies have to decrease prices so customers can afford to buy their product so they can stay in business themselves. But no matter what, inflation will always be there. This is why in 1930 you could buy a gallon of gas for 20 cents, but today it's $4. You could buy a nice house for $6,000, but today it's $200,000. Prices will always increase because populations grow, countries become richer, goods become easier to buy online, while supply always stays the same or decreases while demand rises. Overall, the government has a target inflation rate of around 2%. So anytime prices are extremely higher or lower than that, that's when the government puts into place monetary policies which affect the interest rates. During the COVID era of 2020 to 2021, the government decreased rates because a lot of people were losing their jobs or couldn't get out to spend money. So they wanted to open up bank funds to more people so they could have more money to spend. Therefore, everything was being bought up, such as used cars, houses, household goods, which resulted in higher inflation and increased prices. So now we're in a contractionary period because inflation got out of hand. Supply of houses decreased tremendously, grocery store prices were gouged, and gas prices shot up. So now the government has increased rates so less people will buy houses, which will increase the supply again. and less people go grocery shopping and drive in hopes that prices and inflation will start to decrease. So finally, how can you take advantage of the rising interest rate market? So the upside of this market is that savings and CD rates have increased too. Another way banks loan money is by loaning out your deposit accounts. If a bank loans out money at 7 or 8%, then they can afford to pay you 4 or 5%. So therefore, it's a good time to save and accumulate funds rather than spend. If you save up $10,000, the bank will pay you $400 just to leave it there. That's risk-free money that you get by doing the same thing, which is just by not touching it. So start saving up and check out your local banks for high-yield savings and CD accounts. If you guys enjoyed the video, hit that like and subscribe button below, and don't forget to leave a comment so I can answer your question in the next video.